Good evening, everyone, and thank you so much for coming. My name is Yogesh. I see a lot of familiar faces. I've met them before, and I see a lot of new faces as well. The idea of doing this session is, first of all, to spread more and more financial awareness. And we keep doing these sessions. We want people to come to the office, sit, ask questions more and more as much as they can. And we plan to do these sessions on different topics. Sometimes it's about just basic understanding that how to diversify your investments. Um, I'm sure that some of the other way you have gained your understanding about finance and how it works. But these days, because there's so much information, um, not just in TV or other channels, but these days there are a lot of people on Instagram holding mics and talking about different kinds of stocks. And it
No, no,
becomes a bit
you are on
difficult
diet. You are
to
on diet.
assess that what is right or wrong.
No, it's
Um,
nothing to diet.
Nevertheless, AI has played its role. So we cannot,
No,
these days, if I'm watching a
total
video, it's
fat,
really hard to
49 gram.
determine whether it is AI or
Total
real.
fat, 49
And that
gram.
is how it has become a big issue in investments as well. I want to know how many of you have invested anything, real estate, here, back home, it could be anything. Okay. Those who are not raising hands, I feel that they don't want to tell. I'm sure that somewhere you must have invested. It involves buying gold as well. If you have purchased gold, held on to it, that's a good investment. I'm sure last 2 years it has worked really well. So I just want to know, to make sure that everybody's question is answered, just to know that what kind of expectation do you have from this session. I have my presentation, I have my strategies, I have my ideas, but we'd really like to know from you that if there is something which you really want me to answer, I just want to make sure that it gets covered in the session. So anything specific?
How to use the volatile situation in the market.
How to use the volatile situation in the market. Okay. So this is the question of the whole universe, right? When to buy and when to sell. What you really want to know is how to buy here and how to sell here. How to buy the peak and sell it at the resistance. I cannot tell you that because I don't know how to do that. But I can definitely tell you that how to navigate through the volatility. Because yes, it's a very important question, right? That how to decide whether to buy or sell. We are going to understand this. That depends on the horizon of investments also. Moving on, sir, anything specific which you want me to cover? Anyone can. Yes.
Caps are mostly covered by most of the consensus and other media players.
Yes.
But small caps, how to pick stocks, small caps.
Oh.
So, well, it's difficult to, judge.
Yes. Yes. Yes.
Yeah, just the risk ratio percentage.
Risk reward. Okay. Perfect. Anything else comes to your mind? Anything basic? What to buy, which can make you a millionaire? These kind of questions. How to occurs? I wish I could tell you this. You cannot control your emotions. You can manage your emotions really well. There's one word for it. It's called
choosing the right asset class.
Choosing the right asset class. Perfect. Choosing the right asset class. Yes.
So I want to understand how the diversification, because somehow if you go for the trades in some kinds of the periods, so one goes in profit and one goes totally in the loss.
Yes. How to diversify. So there are different correlations. I'll tell you also that what is the latest correlation which you are able to find out, and we'll cover a market neutral strategy also. How to hedge. Okay. And as we progress, I'm sure questions will pop into your mind. So please feel free to ask. So what I'm going to do is I'll make sure that these things are covered. If not, just remind me that I have to come back to this board and answer these questions. These are very good questions. And this is something which a lot of times, it's not that I'm going to tell you something which you may not have read somewhere, but the practical application is really important. So just to give you an idea, what has happened so far in 2025? So that's something which is really important to understand, because today's topic is momentum or madness. How do we know that when markets are just going up, should I just keep buying, or at what point I get to understand that this is overpriced, right? Because last 2 weeks, markets have been going higher. They are setting new records. In the month of July, the earnings have begun. We have seen new records being built by US benchmarks. Whether it is S&P or Dow Jones, any US stock market index, right now, everybody. So while we were deciding this topic 20, 25 days ago, that what should be the topic, because markets were rallying, we were thinking of keeping a topic that how to ride this bull. And then I realized that back in the past, the experience I had, there's a very much possibility that in the next 20, 25 days, markets might drop also. So we have to come up with something where we can bring your attention to the idea that what goes up can come down as well, and how to assess it. So just to give you an idea, what has happened in 2025 so far, starting from Jan to July, some major events which we have seen: global equity fall and rally. So what happened April first week, if you remember, the most important time, April first week, when Trump announced tariffs on different countries. This was the first week of April, and we saw markets crashing so much that whether it was S&P or any other US index, we saw a fall of more than 12%, and that was in the first week. Why the equity fall and rally at the same time? Because the moment the first week was over, in fact, before it got over, Donald Trump announced that there will be a pause, a 90-day pause on the tariffs, and markets did a recovery, by the way, 10%. So in that entire first 10 days of April, you saw a 12% fall and a 12% rise. So sometimes when you ask that how much global markets can give me the returns, it really depends upon your entry point, right? Sometimes it happens that when markets are falling down, some of you have the tendency to get a bit worried or anxious, and you try to take your money out. And that is where we are making a big mistake, because when markets are falling, that is the time that when you should invest more, in fact, double, because you are getting something at a discount. And I'm not talking about just one stock, I'm talking about an index, right? So we're going to talk about how SIP is done, a systematic investment plan, which you can diversify into. But this is what was happened in the beginning of the 2025. Central bank uncertainty. Central Bank of US discussed about cutting the interest rates back in 2023 and 2024. But because of the tariff fears, it was expected that inflation will rise again. Now, when inflation goes up, the borrowing rate or the loans cannot be cheaper, because otherwise people borrow more money at a lower rate, they spend more, inflation goes even further up. So central banks' pitch changed completely. And that's what pushed markets a bit down. And it made dollar more and more stronger, because with tariff fears, USD kind of became safe haven. Means when people are very uncertain about where to invest, they start buying that asset. So sometimes gold works as a safe haven. Sometimes dollar also works as a safe haven. Even today, if you see last 3 days, US dollars has rallied more than 1.5%, only on account of tariff fears, what is happening. So dollar deposits is also one thing which we really want to discuss about, because dollar has continued to become the safe haven at this point. So we see the central bank uncertainty, we see the US-China trade deal. We saw this in 2016 a lot of times, that Donald Trump would tweet something about the trade deal on China, and then China would tweet back that this has not happened. So markets would face that roller coaster. This is happening again. Even today, if you see, a trade tariff has been put on India as well, at least. I mean, they're still open for trade talks, but we'll see mid-August what happens. But even US and China are going through a talk between how much tariffs are going to be put, and that is why the volatility. That is why the markets have dropped in last 2 to 3 days on US trade tariff talks. Plus, today, tonight, as you leave, you will see that US Central Bank is going to come up with the interest rate decision. So today is a very important day. If you have open trades, you need to be very cautious about it, because majority of the chance is that the interest rates will not be cut down. But there has been so much pressure by Donald Trump on the central bank. He is called the chairperson of the Fed crazy. Today, the GDP data of US came out and economy looks stronger than ever. And again, Trump tweeted that the central bank is too late to cut rates. This is a good GDP. Let people borrow at a cheaper money and buy more houses. But Fed has been very neutral. And that is why it is important that today's meeting, that what is going to be the pitch or what is going to be the future course of interest rates, which Powell is going to talk about. So we have seen the roller coaster in commodities as well. How many of you purchased gold in 2023 or 2024? Physical for, so you're holding on to it, I'm assuming, till eternity. Congratulations, by the way, 2 people have said yes. Who has not purchased gold 2023, 2024? Okay. So do not get disheartened. Gold prices have fallen down today a lot. And if it falls any further, it is coming up an excellent support. So you could always try to invest through funds, something which we can also talk about. But we saw commodities doing a roller coaster, right? Crude oil prices, when the geopolitical tensions arised in the June mid and the June end, we saw gold prices rallying. We saw oil prices going up by 12%. We saw oil prices dropping down by 12%. That was the day when the Iranian air base was attacked by US. And that was the official confirmation of US of participating in the war. And that was a time when we expected that oil would go up, but oil crashed on that day. Another reason that why investments can be really volatile, and we need to understand that why diversification is really important. And of course, crypto comeback, the forbidden word. At some point of time in our lives, we have loved cryptos and we have hated cryptos. And we have been seeing somewhere our faith was there. And then after Trump became the president, we have seen crypto rally, and those who participated, they bragged about it. Those who did not, they kept really quiet, still holding your ground, saying that this is a riskier asset class, I'm not going to invest in it. It's still going up, by the way. We're going to talk a bit about crypto as well, that how you can take exposure in a safer, relatively less riskier way. And then we saw a lot of foreign investors coming back to Indian markets due to the political landscape improving, and we saw the return of the foreign investors in Indian markets. So this is something what we have observed so far, and this is July, by the way, and this is too much of action. Honestly, if earlier I would keep my trades open on a Friday, sleep on Saturday, Sunday, and Mondays, just see what happens. Now I'm too scared to keep my trade open on Friday, because Saturday, Sunday, Donald Trump can say anything, and Monday markets could open at a big gap, which can be in my favor or cannot. So I want to protect myself. That's why I just close my trades on a Friday and just wait till the Monday comes. So we have seen this rally happening. Now, this is what S&P witnessed. And this is, if you see, from 2024, the beginning of January, you see this big fall right here, and then see the recovery from right here. And this is exactly what I want to tell you, that when markets fall, if you get scared and try to stop your trades or try to get out of it, you are losing out on a very big discount, because this is an index. This has 500 companies, and we are talking about the 500, some of the strongest companies in it. Global markets are as important as emerging markets. I talk to a lot of investors. Like, for example, I'm from India. I would like to invest in Indian markets. But at the same time, the kind of products I'm using, I have an iPhone, I wear a Nike, I drive a BMW, I have a Microsoft, I have a Netflix account, I have a Facebook account. All of these are US companies. From your MasterCard to Visa to KFC, McDonald's, Johnson Johnson, P&G, every single product which you're using right now is a global market, right? So while we are using their products, we somehow not invest in it, because either we are not really informed about how these stocks work. So sometimes it happens that we feel that something which we are not really aware about, we don't need to invest in it. That was a very popular opinion. But now I think this style is changing. Because right now, if you're not aware about something, it's your job to actually learn about it and invest into it. Otherwise, you could miss out on an opportunity. That is what has happened with cryptos. That is what has happened with stocks like Nvidia. I think this is one name which you have again loved, hated, now loved back again. So these names will continue to come and we have to control our exposure in it. Now, what is momentum investing? So we always say that markets are running on a momentum. The topic for today was momentum or madness. Why we say that markets are running on momentum? Because momentum means that investors, they have agreed, the buyers, if the momentum is on the higher side, there are more and more buyers who are buying, booking their profits, again buying, booking their profits, and again continuing to buy. It has nothing to do, I mean, it should have something to do with fundamentals. That is how a strong momentum is decided. So that is the difference between momentum and madness, that if you are a part of a momentum based rally, that momentum has to come because of something. Like a stock should not be just going higher if the earnings are coming bad, right? That's your logic. A business should be making profit for that stock to go up. But unfortunately, it's not like that, because in the market, there are people like me, there are people like you who, by the way, run on emotions. Like, how many of you own a Tesla, if I may ask? How many of you own a Tesla stock? Okay, 2 of them. So, see, that's the thing. If you see the profits Tesla has delivered in last few quarters, not very impressive. If you see the stock price which has gone up, that is where the madness comes into it. So there are few principles which we have to understand, that when you're trading on momentums, you just don't enter on the first, second day. You have to understand that typically a 3, 6 or a 12 months period of momentum. You have to understand that to be a part of a momentum, the market should be going in that direction at least for 3 months, right? Don't just fall for it. If someone tells you that, this stock is going to go up, just go for it and buy. So this is one herd mentality which a lot of us go through because of lack of time or expertise. We just hear what others say and go with it. Relative strength over absolute value. So this is something which you have to understand, that whether the stock is just rallying because people are talking about it, because everybody is talking about it, or the fundamentals are actually strong. The earning ratios or the earning per share has actually increased or not. For example, Netflix continue to rally for last few quarters, but if you see Netflix's earning per share, it has continued to improve. The average number of users which are increasing continues to improve, and the stock has continued to go higher. So if you had seen Netflix in last 1 year, the stock from $850 has gone to $1,250, right? And it's been last 1 year. So even if you have bought that stock 6, 7 months ago, the stock is still rallying. Time frame matters, of course. Momentum can be short term, can be medium term, can be long term. Traders often focus on shorter windows. Investors target long term cycles. So somebody asked me this question, right? That how long to keep investments for? It really depends. If you are a long term investor, like a Warren Buffett strategy, that you buy a stock, hold on to it for a longer period of time, and the stock grows in value, you make a lot of money. Or you want to keep the short-term gains. You bought a stock, it went up after earnings, and you made money on it. Still, I would tell you, if you compare a trader versus a long-term investor, over the long-term investors have a higher chance of making money. Because you buy a stock, you hold on to it, you do not let the smaller crashes and falls come in between. You go long on the stock. Just like if you had bought any index, even 2 years ago, it is upward sloping in the direction. In 2 years, markets crashed. It did come down, it did move higher. So long-term investors, I obviously feel that at this point of time, we have to divide our money in a way where our long-term investments are taken care of. And whenever we get the chance to enter into these short-term opportunities, your cryptocurrencies or sometimes gold, for example, or crude oil, for example, depending upon what events are going on, we should take advantage of that. Because right now, this is a very, I think the world has been divided into pre-pandemic and post-pandemic era. Pre-pandemic, people were not really aware about how trading, I mean, they knew how trading works, but maybe they just never wanted to get into it too much. They wanted someone to do it for them. Post-pandemic, people realized that I need to learn this. Movies were made, documentaries were made, the GameStop sagas, the meme stocks, right? The surge 400, 500% in the tech companies made you feel that you want to be a part of this. Plus, a younger generation has started taking part. If you see today in many parts of the world, whether it is India or UAE, anywhere, the youngsters are now just opening trading accounts and just doing it. So now is the time when you have to take part in these short-term price movements also. Again, a momentum needs to be catalyst fueled. So as I said, that there has to be some sort of push which the stock has gained because of that momentum. So whether it's a merger news, like for example, AI stocks surged in 2023 due to ChatGPT hype. So we saw that in 2023, a lot of tech companies went up because the role of AI started becoming more and more important. Even now that rally has continued to go higher. So if you see chip companies like TSMC, Taiwan Semiconductor Manufacturing Company, ASML, Nvidia, all these chip making companies have rallied. And these returns, sometimes it takes 2 or 3 years to earn these kind of returns, but these stocks have already gained it. Now, moving to the idea, what we do wrong, sometimes we don't look at the valuations at all. We just look at the name, right? So if I like a company, if I own a product of that company, I would just go ahead and buy it without even seeing the balance sheet. FOMO is the biggest reason, and I think somewhere that's where the emotions get involved. Fear of missing out. You see markets have gone up, you have not participated, you see the other person talking about it, you see the stocks is already going higher, you enter at the time when it is coming down. So that is one thing which becomes a part of this madness. And then, of course, we have seen social media hype. We have seen sometimes the stocks, they come up with poor earnings, but still people buy. Tesla is one of the biggest example of that. Each time Tesla missed out on the earnings, Elon Musk comes out, talks about life bigger than what it is, talks about SpaceX, talks about what Tesla is going to do in the near future, and the stock jumps higher. Even after his feud with Donald Trump, we saw the stock coming down, and again, the stock rallied because of a loyal investor base. So we have to find out the difference between, because numbers don't lie, especially when you're looking at your balance sheets, you're looking at your profit and loss. That is where the decision to buy the stock should be made. Now, this is what I was talking about. Sometimes there are these companies, pets.com, GameStop, Sun Edison. These are the examples of these companies which have gone straight up arrow in a day and then came down after a lot of investors thought that they have missed out on the rally. See, this peaked around $33 in July 2015. Ambitious expansion plans fell the very next year, filed for bankruptcy. Again, excessive debt. So we have to find out any company or any stock you're buying, the interest coverage ratio, the price earning ratio, the debt ratios. This is the fundamental part of it, especially when you're a long-term investor. A short-term trader wouldn't care about it. If you have to place a trade for today, it does not really matter what happens to the stock after 1 year. You don't really have to look at the balance sheet. You just have to look at the price action. So there are two different ways. How an investor is investing, how a trader is looking at it. A trader is not going to look at the balance sheet. He's going to look at the chart for the last 4 hours and sees that, okay, price has dropped to this level. It is going to bounce from here and I'm going to buy it. But a long-term investor needs to find out the numbers. If you're going to invest in a company for the next 2-3 years, this is not enough that you're buying Apple because you carry an iPhone. It's not enough. You need to know that how many iPhones Apple is going to make in the next quarter, what are the previous earnings, what is the revenue which they have generated, and after that, you take that decision. Even sector-based, which sector is doing good right now? Is it good to invest in tech when inflation is expected to go up? No, because if inflation goes up, central bank doesn't cut rates, which means investors dump tech stocks first. They start buying bonds. They start investing into quality companies which gives them dividends. Tech stocks do not give dividends. So you have to take that decision that when to step into the market. Now, these are a few things which we can try to find out. So I'll give you the examples. Sometimes, how do I know that when markets are on a momentum, it's kind of fake? So if you see this, there is a lot of divergence between the economic indicators. In February, S&P 500 was moving higher. But if you see the manufacturing data of US, it was going down. It was not right. So if manufacturing is dropping, there is no reason for the index to go higher. So this is how you know that this is just the buyers trying to take advantage of the momentum, but it is not going to last. Second, private credit spread, you will see the interest rates between the intermarket and the private companies starts increasing because investors get more cautious when they are loaning their money because of lack of confidence. And then merger multiples. So in 2021, if one company has to acquire another company or merge with another company, they were ready to pay a higher multiple. So it's like you want to buy a premium car and you are ready to pay higher money for that, right? But now, if you see in 2025, we have seen this thing coming down by 37%. So today, if one company has to take over or merge with another company, they're very cautious about how much they have to pay to acquire that. Because especially if it is a cross-border company, say today there's a company in US which has to acquire a company in China. That company does not know what is the impact of trade tariff on that company. So they are not willing to pay as they used to. So the multiples have come down for a lot of these companies. So you need to find out the difference because a lot of people continue to ask me that this rally which is happening right now, should we just ride the bull? Should we just start buying? And that is where I want to tell you that just buying the stocks should not be the only way. There are multiple strategies which you can do. If you see sector specific, and this is live as we are talking even in July, if you see the tariff part, tariff on steel, aluminum, automotive parts, they have drove up the cost of the products by 10-15%. But if you see the stocks which are in the manufacturing and tech, their PE ratios are higher. PE ratio means the price of the stock versus the earning, right? So when we talk about PE ratios, it shows this. And this is a very common multiple to talk about. So price earning ratio, which means whatever the stock price given the earnings. So whether the stock is overvalued or not, stock is overvalued or undervalued. So we have seen this thing that these sectors which are expected to be heavily impacted by the tariff, the companies in these sectors, they're still higher PE ratios. People are willing to pay more to buy those stocks. Why? What is the reason? If you know that tariff is going to increase the cost of this product, it's going to decrease the revenue eventually, why you are willing to pay more for this? This is a question which you need to ask. So obviously you are thinking that as a normal investor, even if I have access to these numbers, which you have, by the way, because these are publicly listed companies. So if you search financials of Tesla or Apple, you will find out all these numbers. But the point is, who's going to interpret this for you, right? This is the time where ChatGPT does everything for you. But I would still suggest that that is where an investment consultant is required. Investment consultants are like doctors. You think that you don't want them, but you need them. Like sometimes when you have a bad headache, you Google out why I'm having a headache. Google shows you have brain tumor, right? Never, this is the first thing a doctor tells you, never Google if you have a headache or a stomach ache, anything. That is how investments are also to be taken care of. So we are not saying that you don't have to be independent, but a second opinion is always, it's really important from an expert, from a professional, because what goes out there, what you see every day, you see a bull running at its highest peak, but you still are not aware that what's happening. So it's always better to take opinion, to take what's going on. Now coming to the idea, which is more important, the different kinds of strategies. Okay, so we need to know the first thing to reduce this risk of getting into a wrong momentum. You buy stocks, you buy index, not a problem, but you need to keep investing regularly, right? Regularly, you have to stay invested, you have to diversify, and we are going to go through this at how you can diversify it. So there are different kinds of strategies which we are going to learn today. Seasonality analysis, price action, market neutral. And that brings me to the point where I can answer a few of these questions where I can start with. So, okay. Emotions. As I said, emotions is something which cannot be controlled. I hope that was that easy. The numerous breakups I had in college, I would just switch off my emotions like that. I'm sure a lot of you would have thought about it. But the point is, we cannot switch off the emotions. Like we're humans. We can manage them. And a key to manage the emotions is, first of all, the big thing is diversification. Why your emotions are high? Because you are invested into that one specific asset class. You're majorly concentrated on one thing which is not going in your favor. So you get under panic and then you take a decision which you would probably regret. So first thing to manage emotions, you have to manage your risk, and managing risk for a trader, two words: stop loss. How many times I've talked about stop loss in these seminars? 100%. The percentage of the clients and traders actually putting a stop loss, 1%. Why? Because nobody wants to book a loss. Today, if I start my words by asking you that yes, it's a good investment, but I want to know that how much money you're willing to lose in this, you will say zero. What kind of question is this? Why I'm supposed to lose money in this? You have to have a risk reward. Somebody asked about risk reward ratio, right? So so I'm telling you, for a trader, risk reward ratio 1:2. We always hear it. We never apply it, by the way. But if you start applying it, you will see that how it affects your portfolio. This is for the traders, the short-term traders. 1:2 risk portfolio, very simple. That when you are placing your trade, the amount of money which you are willing to lose, it should be less than the amount of money which you are willing to earn. So if you are expected to lose $50, you should aim for at least $100 profit. This is what 2:1 means. You know why this statistics is important? Consider this. There are 4 asset classes: commodities, currencies, indices, cryptos, for example, or bonds, for example. If you take 4 trades every day, there are some 20 days of trading, excluding Saturday and Sunday. You're doing around 80 trades, right? 80 trades put, and in those 80 trades, you have put a stop loss of 1 and take profit at 2. Even if 60% of your trades go wrong, which means 48 trades went wrong. So what is your loss? 48. 40% of the trades went right. You see this? Obviously, commission spreads, not concerned about that, but you see what I mean. That even if you're wrong 60% of the time, you still end up making a net profit. And this is not something which you have to try on your live accounts and see. Do it in practice accounts. But my question is, have you ever done this before? How many of you have heard about 2:1 risk reward ratio? So common, right? Have you ever done it? You've done it. Does it work for you?
Yes.
It works for you. Works for you. So it's working for them, which means there has to be a strategy. So I used to talk to a person, and he used to call himself as the chicken trader. Okay. It's very interesting. What he would do, he had a pet chicken, he'd get up in the morning and keep 2 cards, buy and sell. And he let the chicken pick whether to go long or short on a product. And each time, whatever the chicken picked, he went on. But he followed this. And he told me that I don't even have to do any analysis. I just pick what my chicken tells me, but my risk reward is always 2:1. So at the end of the month, he would end up making money. I'm not saying that don't look at the charts, don't look at the trends, just go and speculate. That's not what I mean. I'm just trying to tell you that a powerful risk reward ratio automatically control your emotions. Because if you have put up a stop loss, you don't need to be awake in the night, right? You know that this is the amount of money which you are willing to lose. I wish there was a something very big and sophisticated to control your emotions, but it is that simple. A risk reward ratio of 1:2, a stop loss feature which is available. Sometimes people like to hold on to their profits, right? But even at that point, you can do this. This is your buying price. This is your stop loss. So if the price goes up, at least move your stop loss higher. So in case if it comes down, you still end up making some money. A lot of people, this is called a trailing stop loss. It's again a very common feature, a very easy one. But we kind of eliminate the stop loss completely from our profile. Now, coming on to the idea that how to do different kinds of strategies. So we diversify first. Diversification is how we have to separate it. So there is something very important which we need to know. This is your base of the investment, right? Fixed deposits, savings account, and then emergency fund. This is something which COVID taught us, to have emergency fund. What is emergency fund? It's your go-to bag. If you have to run away, you need cash, right? But emergency fund basically means that if you were locked behind doors, like what happened in COVID, and you don't have a job for the next 1 year, you should be able to survive. So whatever is your monthly expense, you calculate that, multiply it by 12, that's your emergency fund. You need to have that money in excess. It should be liquid enough. Your savings account, your fixed deposits, obviously those who seek interest, if you keep money outside UAE, you will earn an interest. Here, the banks may not give you that much unless you are a gold member or anything like that. A normal fixed deposit savings account here does not give you much return. But back in different countries, you could put that money and earn that. Why you need this? Because this is the base of your investment, right? I went to University of Dubai to do a session, went to Middlesex, and I asked them that how many of you invest? Just graduate students, good students. They said, no, we don't invest. Okay. How many of you trade in cryptos? All hands are up. Right? Again, I don't want to call them wrong because that's the next generation, right? We have the tendency of thinking that the people who are born after us, they're brainless. But the people who were born before us, they don't know more than us. This is what we have tried to maintain it. But when I spoke to them more about it, it's just the idea of making quick money, right? We have to understand this. Money can be made, but any shortcut to become rich or get that tip from somewhere and invest in that stock and become a millionaire, it happens in movies. If it happens in real life, you don't know that those people. I'm sure anybody who's sitting here, even if they have done it, they will be very quiet about it. But you have to go step by step. So this is your money which is kept safe. Okay, this is liquid, this is safe. You move on, and now you start investing into something which is more fixed income. I'm talking about bonds. Bonds means that you are getting a loan to someone and they are paying you an interest over it. In this case, I'm talking about a government bond. So imagine that US government needs money to build hospitals, infrastructure, bridges, and you are giving them a loan on which US government is going to pay you an interest of 4 to 5% every year. This is called a government bond. So this is your fixed income, right? Like government bond, there's a corporate bond also, by the way. Companies also issue bonds where they will pay you a fixed interest, not stocks, bonds. And that interest will be higher than what you are getting probably in a fixed deposit. It depends on company to company because the risk is higher. Then you move on and you invest in real estate, mutual funds, all these blue chip stocks, right? Real estate, must, very good investment. If you were to beat inflation, two asset classes, stocks and real estate. You should have investments in both, but not just in one of them. Should have investments in both. I always feel if diversification needs to be done, it needs to be done like this, that some of your money is in real estate, some of your money is in stocks because of liquidity. Money is supposed to be, investment is supposed to be liquid, right? Why we use the term liquidity for money? Because it is expected to flow. It should not be stagnant, right? If you need money, you should have it. Real estate is an illiquid investment. Today, if you want to buy a piece of land right away, it will take time. And if you buy it, somehow you want to sell it right away, it will take time. But stock, if you buy it right away, sell it the next second if it goes up, you can easily convert it. So you need a mix of both. And then you reach at the tip of this pyramid, and this is trading in crypto options, your short-term trading, you putting your stop losses, this right here. This is the tip of your pyramid. Now you have to ask yourself that how many of you are directly dealing with this without even looking into Because I'll tell you why. Because from bottom to top, your risk has increased, right? But what also has increased? Reward. This is simple risk reward. You keep your money in the bank, you will not earn a higher return than a real estate or mutual fund. You can buy a government bond, you will get interest. Again, it will not be higher than a real estate or a mutual fund, depending on a good year. But risk is also higher. What is more safer, real estate or keeping your money in the bank? Sorry?
Bank.
I'm just going with a very traditional idea that why I would keep my money in the bank. I mean, obviously, real estate, you buy a house, you hold on to it. I get that part. You buy a house, you hold on to it. But I'm just saying that as an investment, if you bought a piece of real estate, there's a chance that developer did not give the delivery. Like we saw this happening in India, in Gurgaon, a lot of times in Noida. A lot of people actually lost money because the developers just left. Bank, assuming that there is no yes bank kind of an incident, most of the time we feel it is safe. So your risk and rewards move from the bottom till the top. So yes, you can make a lot of money in trading, but you can lose also a lot of money in trading. So that's why you need to diversify. The biggest problem is why we are so stressed about trading, because we have put all our money into it. This is the money which we had, and this is what we have put into trading. Do not put money into this if you have not sorted out this. You need to have some fixed income investments. You need to invest into some blue chip, good stocks which gives you dividend. There are companies which gives you fixed dividend. Coca-Cola, for example. In 1 year, Coca-Cola would move $6 to $7 tops. But it gives you around $3 per share dividend if you hold on to the stock for entire 1 year. Same goes with companies like McDonald's or Starbucks or other kinds of companies. A lot of oil companies, ExxonMobil, British Petroleum, Chevron. ExxonMobil stock dropped in COVID, not because of anything else, because the company continued to give dividend to the shareholders from their reserves. So the analysts got so negative that where they are giving dividends to the shareholders from, this will not survive. So they started dumping the stock. And then ExxonMobil had to cut out their dividend for the first time in so many years. So you can pick out those stocks. Two different kinds of stocks. One is growth, one is value. Growth is your tech, the darlings of Wall Street, right? Apple, Alphabet, Tesla, Amazon. These are the ones which are billionaire, trillionaire companies now. Nvidia, for example. You have to participate into it, because these are the companies right now. If you're not a part of this, so you have to decide for yourself that how much money needs to be allocated, right? So if this is your portfolio, at what age group you are, if you are a student, 18, 20, 25-year-old, majority of money could be put into stocks. Why? Because you're at that phase where you're going to earn more money, so you can take higher risk. Taking higher risk is not a taboo. It's not something which is bad, and it is not related to gambling. Gambling is gambling, high risk is high risk. It has no relation. High risk means that you are willing to invest into something which can fetch you higher returns. So when you are young, it makes more sense because you can earn more money. But if you are retired or you are going towards retirement, do not put a lot of money in stocks. You put money into something which gives you a fixed income, right? Like bonds, for example. Even within stocks, again, if you're a, say, 25 to 35 to 40 years old, you can put more money in tech, less money in fixed income, dividend stocks, because tech will give you more opportunity to make more money. Think about Nvidia and Amazon's. In last 5 years, their growth has been triple digit in percentage terms. So you have to allocate it, but when they fall in style. So you have to be very cautious. This is how risk rewards needs to be calculated. You have to make a pyramid or a ladder, and you have to list your assets from the lowest risk to the highest risk, and then understand where you fall on this ladder. What is the amount of your income? How many people are depending on you if you lose your job, if you lose this money? What is your retirement expectation? They used to say 100 minus age. They say 100 minus 35, okay, 65. So 65% put into stocks, remaining you put into bonds. As your age increases, 100 minus 70, 30. So 30% put into stocks, 70% put into bonds. It really depends upon your risk and reward. But asset classes, you should have exposure to all of them. Today, cryptocurrency has become an asset class. I know initially I hated more than you did, but the whole point was that when you see the markets rallying, who is investing in cryptos? This is the next generation. This is the Gen Zs who are investing, and the institutions, by the way. Why Bitcoin has gone up so high, why Ethereum has gone up so high, why Solana has moved so higher? Because there is a lot of institutional participation. The institutional, the hedge funds, they're buying cryptocurrencies in bulk. The big companies, MicroStrategy, Nvidia, they're buying cryptocurrencies in bulk. That is why stock has gone higher. Ethereum's target, by the way, it is at 4,000, 3,800 something. Ethereum's target long term, it is $11,000. Now, my question is that one coin Ethereum is $3,800, right? If you feel that this is something which you don't want to be a part of and this is scam, sham, $500. Buy point something of a coin and forget about it. But participate. You don't know what you're missing out on, because that is the problem. Today, investment is not as simple as Warren Buffett used to think, that buy a stock, look at the financials. These days, people are riding these momentums, and sometimes you can miss out on the rally. So I'm being very practical here. Okay. Whatever your thoughts are about cryptocurrencies, unless you are halal and haram concept, that's a very different concept. But other than that, if anything else stops you from investing in cryptos, it should not. Solana coin is $170 one unit. It went down to almost 100 during April, and now it is $170 per coin. So you have to identify these cryptos, and these are not meme coins, by the way. They solve a magnitude of a problem. Ethereum is like an internet to the crypto world. Solana is a much more sustainable form of Ethereum. Bitcoin solves cross-border currency transactions. So today, if you feel that you have missed out on the Bitcoin rally, which I am telling you, by the way, you have not, because even if it comes down, there is a lot of institutional hedge funds who are willing to buy it. So even a 0.0001, even $1,000 worth Bitcoin, if you just buy and leave it, at least your risk is very limited, right? If you lose $1,000. But if it goes up in value, like I put 400 dirhams in Bitcoin in 2013, 400 dirhams. When the Bitcoin reached around 95 or 96, that 400 dirhams were 10,200 dirhams. Now it is $120,000. JP Morgan is talking about going to 200,000, even more than that. What is my actual investment? 400 dirhams. What do I care about? Even if I lose this entire 10,000 dirhams, I have not taken it out. I'm holding on to it. When I bought Bitcoin, I did not even know what Bitcoin was, right? But that did not stop me from buying it, because, again, riding the momentum. So sometimes it feels ridiculous, of course. If you have access to any, like if you have children home, tell them to learn about it and then teach you. Otherwise, you talk to somebody who knows about it, but do not miss out on this, right? So this is how we have to start diversifying it. Now I will show you a strategy, which is, so somebody asked me a question, how to hedge this thing, right? And please, in between, if you feel that you need to ask any questions, please do ask. So we are going to talk a bit about different strategies which came out as we were exploring different ideas. Okay, so let's talk about something which is called a pair trade. Okay. Now, pair trade is something which is very common. Okay. But this is something which a lot of people have not done it before, because, again, it includes commodities. Now, this, what I am telling you, this is apart from the pyramid which I have already explained. So your vanilla kind of investments is here. So I'm assuming that you have done your fixed deposits, you're getting your fixed income from bonds, you have invested into real estate, stocks, and now you have reached to that point where you are at the tip of the pyramid. You want to trade and speculate, but you are not able to understand where to invest in. So there are two ways to do it. First, look into many trading calls where you can see the buying and the selling levels, enter, put your stop loss, have that part. That is one way to do this. Second is exploiting different kinds of market movements. One of them is called market neutral strategy or pair trading. Okay. Pair trading is something which is, I mean, it can really help you to diversify your risk during troubling times. And I'll tell you the reason why. There are two kinds of oil which are traded. Okay. And by the way, this is not just for short-term traders, for medium-term investors who have done all kinds of investments, but you are looking for something different, something else, or something more of an opportunity. There are two kinds of crude oil which exist. One is Brent, and one is called WTI. Okay. Brent comes from the North Sea. So Middle East is concerned with the Brent oil, the quality of the oil. This is the international benchmark. While WTI, the source is the Canadian oil rigs, the US oil as we know it. Now, this is where it becomes more interesting. So Brent price, let's say, if it is 70, WTI will be around 67. So as you can see that there is a difference of $3 at the moment. Now, this is where it becomes interesting. Is this gap between these two oils, is it always $3? It's not. Can anyone guess what is the highest it has been in last 7-8 years? 140. Okay. Highest price difference, not the price of oil. $5. Okay. 50, 15 or 50? 1.5. Okay. Last 7 to 8 years? 10. Okay. So it has been around 54. This was in pandemic, by the way, to clarify. Otherwise, you would not see this big difference. So consider this thing. There are two kinds of crude oil. Crude oil is that raw oil which is extracted from the earth and then refined further into petroleum. And this is heavily traded also. Two kinds of crude oil. And both of them have a price difference. Right now, it's $3. It has gone as high as 54, which means that if one oil was trading at 154, another was trading at 100. That is how the gap of 54 would have come, right? This is what the price difference means. Now, imagine this. This happened in pandemic when US oil went down to minus 34 while Brent was around 25. So all of you know that in April, oil prices were allowed to go negative so that the future contract holders, they avoid the delivery and because they could not buy the oil because there was nothing to, there was no storage to store it at. So the exchange allowed oil prices to go negative, which is not a concept, right? Negative means that I'm buying oil from you and at the same time you are paying me to buy that oil. But on electronic platforms, it was allowed to go negative. You could not buy anything here. That was for one night. And next morning, again, the contract changed and it went. But the gap reached to $54. Now, after pandemic, which was taken as an anomaly, this has been around $6 to $7. Okay. And sometimes around $3 to $4. Right now, say 3. When the US-Iran issue happened, this gap was reduced from $3 to $1, which means that if Brent would be 70, WTI would be 69, $1 gap. Now, this is where a lot of traders, even medium-term investors who are still holding on to this, what they have done, they saw this gap, which was $1, right? They expected this gap to get back to 3 or 4. So what they did, the oil which was expensive, they bought it, and the one which was cheaper, they short sell it. Short sell is a process by which you can borrow a product from the broker and sell it in the market. And once the price drops, you buy it back at a cheaper price and keep the price difference, give commodity back to the broker. This happens on online platforms a lot. It's very common. So while you can make money from the rising markets, you can also make money from the falling markets by borrowing the product from the buyers and selling it live. This is what they did. This is called statistical arbitrage. This is something which a lot of investors, they are not aware about it. Maybe because it is called arbitrage, so the terminology is a bit weird to go into detail, or sometimes the brokers just don't tell. Because an entry point like this is less riskier, more rewarding. I would not say risk free, I would not say zero risk, because risk is always there, but lesser risk, because if I have seen that on an average, this gap has been around 3, this is what the gap has been, and now the gap has reduced to 1, I expect either this to go up or this to come down and the gap get bigger. And these are two very similar products. I'm talking about crude oil. And this is what has happened, by the way. People who took this trade in June, around June mid, they're still holding on to this trade. And this gap has gone $3.5, which means if you had purchased 1,000 barrels, right now $3 movement, it's $3,000 profit. $1,000 is somewhere around $70,000 worth of oil, but you use leverage on your platforms, so your depositing of money is barely around $5,000 to $6,000. Leverage is high, but if you put your quantities lower, then this is a very good strategy. This is not something which is available 12 months, but this is that kind of an opportunity. So what everyone needs to do right now, you need to have a long-term account, you need to have a short-term account. Long-term account is for your stocks, for systematic investment plans, right? Where you could buy and hold and do not pay any leverage cost or any holding cost, because interest rates are high right now. But once interest rates are low, you could always do SIPs in a lower interest rate environment and take leverage. But right now, obviously, you need to have a long-term account, a short-term account. See how this one played out. So look at this strategy, for example. If you see this, we started with, so just to give you a fundamental idea, oil surged 14%. This is the previous strategy. This was a time when the price difference actually came down. And if you see, oil prices went up 14%, reaching multi-month high after Israel carried out widespread strikes on Iran, prompting immediate Iranian retaliation. And then we saw here that in contrast, the US oil, the domestic crude, is less exposed to the Middle Eastern supply routes, making it relatively insulated from immediate geopolitical shocks. So what was the reason why this price gap increased after June? Because of the geopolitical war, supply issues, the Brent oil, which is the Middle Eastern, the European oil, that went up faster. US oil, which was very less related to this whole geopolitical issues in terms of supply shocks, it remained around with the same price. So one went higher, the gap increased, and that is how people have capitalized on this opportunity. This is something which you have to. So right now, the chart which you see, look at this chart. So what I was asking you here, this is since 2020 or 2021 beginning. The chart which you see is not of crude oil. This is the difference between the two kinds of crude oil. Okay. And if you see this, look at the difference. This was in 2022, highest 11.3. And look at the lowest, minus 68 cents. What does minus mean? Minus means that US oil became more expensive than Brent, which rarely happens because the Brent is the international benchmark. But if you see after that, this is where it was, 1.08. Now, if I'm looking at this chart, this is 2025, I'm looking at this chart, then in 2022, it went down to minus 0.68. Now, finally, it has come to 1. Otherwise, it has been trading around $6 to $7 price gap. It's a good entry point. Whether you know about this or not, you need to learn with your investment consultant, because this is a different avenue of investment, right? Yes, it is slightly high riskier than your fixed deposit, your real estates, because we are looking into commodities directly. So as I said, there are two ways you could do this. You can have a trading account, you can talk to a consultant, you can see those trading levels which are distributed everywhere now, very common. You can put your stop loss, can have a one-sided trade. This is a part of the hedge. This is called hedging or protecting your portfolio also. This is called statistical arbitrage. This is called market neutral strategy, by which you're not exposed to only one instrument. You're exposed to two of them, but that negates the risk because they both move in the similar direction. You're only speculating on the idea that one will outperform another. So imagine there are two brothers, they're twins, they do everything the same way. When they run together, they run exactly at the same momentum. But a time comes when the elder one, slightly elder one, surpasses the younger one. And that is where you see that one has outperformed the another. Until then, you will not see any action in your portfolio because it will be the same. You have bought one, you have sold another, so it's neutral right now. But a time will come when one of them will outperform the another. That is where your profit starts coming in. So if you get a chart like this, you need to talk to your consultant. So right now, if we start looking at crude oil or we start looking at any other product and see how much is the difference, it will be around $3 or $3.50. But the moment it comes down to one or say 80 cents, for example, that is a good point of entry. So this is called market neutral strategy. So a lot of you who have short-term trading accounts, you should start looking into these kind of strategies because guess what? What you are able to do in Brent and WTI, you can also do this in gold and silver, right? There are two ways of investing in gold, by the way. So one is you buy the commodity directly. So if you have a trading account and you buy gold in your trading account, you will end up paying a holding cost because you are taking a leverage on it. You cannot have a non-leverage account and buy the commodity. It's not possible. So you must take leverage. This is with every broker. Another way of taking exposure in gold, it is called ETF, Exchange Traded Fund. Okay. So there is an exchange traded fund called SPDR Gold ETF. SPDR is a US based company. It's a very old company. And if you want to take exposure in gold, SPDR as a company holds gold TT bars physically. So tomorrow, if you are investing into that fund, you are basically indirectly tracking gold prices. If gold value goes up, the value of the ETF also goes up. And that is your way of buying gold non-physically, which prevents you from the idea of storing gold anywhere. Today, if you have purchased physical gold kept at your home, I'm sure if it is too much high in quantity, don't tell me how much, but if it is, you will not be able to sleep properly. Always be worried. Touchwood, this is still Dubai. God knows if there is any other country where the crime rate is much higher, you're not able to buy gold physically and hold on to it at your place. So what do? You buy through ETFs. Your online accounts allow you to actually, and one very important thing, I think a lot of people must have heard this, but please look into this. Many analysts have talked about this since beginning of the year, and it has already happened. Silver is right now much more undervalued than gold. Silver's physical demand is much higher because with the growing demand for semiconductors, silver has become a very important commodity, and there's a big supply and demand gap between silver. And since the beginning of January till now, silver was around $32. It is already $38, $39. And year before that, it was around $24, $25. Year on year, silver has continued to grow. Not in the same percentage manner gold has, but this year and the next year, silver prices are expected to go higher. Again, the safer way to take exposure is through silver ETF. ETF is a less riskier way because if you invest directly in the commodity, the daily volatility, it kind of bothers you. So if you're not a trader, you're a long-term investor, again, you can do silver investments through silver ETFs. So this is one way of doing this, that you are buying an ETF and you are fully focused on that the prices will go higher for gold or silver. Another way is something what we call it as a gold silver ratio. Okay. Gold silver ratio basically means, what is a ratio? Ratio means, so what is the price difference A minus B. Right? Price of A minus B is the difference. What is the ratio? Price A divided by price B. The ratio of gold divided by the silver. So basically, how many ounces of silver are needed to buy 1 ounce of gold? So today, for example, if gold price is 3,304, silver is say 36. So you divide these prices, you will get something called a gold silver ratio. Do you know that how many investors have been trading in gold silver ratio since 1970s? They have been trading in gold silver ratio, not just gold, not just silver. And I'll tell you also, there's a whole full-fledged chart which exists, which shows you the gold silver ratio here. Right now, the chart which you see, this is not the chart of gold or silver. This is the chart of gold prices divided by silver. Again, this is something different, something new. If you're here, there has to be some sort of value addition. So look at this, how much it is right now. 87.4. Okay. Can you see this? That so many times it has been around these levels. So it was, let's say, maybe last 5 years. Okay. Look at 2020. Slightly here. See what happened here. Okay, see this peak. So if I see gold silver ratio is here, how much it is? 125. Right now it is 87. This is 125. What does it mean when gold silver ratio goes up? So if I say gold silver ratio here, this is 85 and this has gone to 125. This means gold prices have rallied more than silver has. This is one way of, the shortest way of telling that when ratio goes up, that means gold prices have rallied as compared to silver. Or if silver has gone down more than gold has. In both ways, gold has outperformed. This is another form of arbitrage because when you see this has gone up, and why this happened? So if you see the year, this is the year of pandemic. So you see there is a skyrocketing increase where gold, because it's a uncertainty asset class, it's a safe haven asset class. During pandemic, gold prices shot up, but due to lockdown and uncertainty of what is going to happen to the trade, silver prices dropped. That is why the silver dropping and gold going up, it increased the ratio to 125. The moment lockdown was removed, vaccines came into the picture, what happened to the ratio? It went down, which means gold dropped, silver rallied. This has been going down for years and years and years, has been going for years and years. And now if you see again here, so these are after 2020, and look, this is in 2025. This is exactly the time when geopolitical issues were going on. Look where it was, 105. Where it is right now, here, it has come down. Look at this big fall. Do you know how, and look at this level, 78. You see the 78? This is where a good entry point for this ratio is. Because if it touches here, expect it to go back, which means once it touches here, you should buy gold and short sell silver. Again, equal value. This is another form of arbitrage which you can do. These are the things, guys. This is what hedge funds do. You can invest as small amount as you want. Obviously, strategies like this, because they are based on a small movement. So for high net worth individuals, this is a very good strategy. But even if you want to be a part of it, you can have your smaller values. At least this way you will get to know that which is going to outperform, which is going to underperform. Imagine if the ratio comes to this level, where somewhere around this right here, this is 75. We have seen that it comes here and bounces back, comes here and bounces back, comes here and bounces back every single time, which means this is where you need to start buying gold and selling silver. So these kind of levels, of course, the when we sit with the clients and when we talk to the consultants, these kind of strategies continue to come. Do you know the same kind of ratios which are Brent, WTI, gold, silver? There is a ratio between soybean and corn also, agricultural commodities, which a lot of us are really not aware. But while this is happening, we talked about something called seasonality analysis. Okay, seasonality analysis also is an opportunity-based investment. So you pick out the agricultural commodities which are traded a lot. So cotton is one of them, by the way. Cotton, soybean, these are asset classes which we kind of not look at it because it's not too much talked about. But so many traders, so many investors are buying. If you see copper prices, for example, copper prices have rallied after Trump put copper prices have gone up a lot, but a lot of us are not aware about it. Similarly, cotton is one of those commodities which is traded a lot. Now, what we did, we tried to analyze the cotton percentage returns for 20-25 years, and we realized that 65% of cotton is produced from India, US, and China. Cotton is grown in humid weathers. So December is the month where all three countries have winters, and that is why the supply of cotton is reduced. So we realized on a heat map that in last 25 years, 20 times cotton prices go up in December. That is the hit ratio. Because now you are thinking, earlier you were not aware of cotton, now you know a seasonality part of it. This seasonality can be studied in different agricultural commodities, right? So seasonality analysis, market neutral strategies, there is also something called price action analysis, what you do during the earnings season, okay? So during the earnings, this is something which we also provide, and this is not something which you can find it out on Google because price action analysis requires a lot of back testing. Okay, let's see if this is, yeah. This is one strategy which can really help you. So this is for stock investors. Okay, all of you who are short-term stock investors who would like to buy stocks trying to make a higher amount of return. Again, please understand this. Each time when I say high return, the high risk should be implied in a disclaimer, which I'm not saying again and again. Okay. This strategy can help you capitalize on this part. Why? Because when does a stock moves at the best of their movement? When their results are being announced. Earnings. There is a concept called earnings season, and earnings season comes every quarter. It's like a report card where each company comes up with their earnings and numbers, tell us that how they have performed. There are three things which you need to know in the earnings season. And by the way, this is anyone can do this. You don't even need, by the way, a consultant for that, because this is the news which is out and about. When you're looking at the results, you need to see three things. First is earning per share, which is called EPS. Earning per share basically means whatever is the net income of the company divided by the number of shareholders there are. So it's earning per share is basically that how each dollar invested by an investor has been utilized, how efficiently it has been utilized. So if earning per share was, for example, 60 cents, right? If it was 60 cents, it has gone to 90 cents, which means net income has increased, right? The numerator has gone up. So earning per share is one of the most important thing. Each time, if you're looking at the earnings news, you see how much earning per share was expected by the analyst and how much it came. If it came better than the expectation, most of the time you expect the stocks to rally. Netflix, 3-4 quarters ago, the stock price was $850. After the market was closed, Dubai time in the night, earnings came out. Earning per share better than expected. There is another thing which is called revenue. Okay, you know revenue, what revenue is, the total revenue which is generated. Revenue better than expected, and the most important thing, future guidance. Future guidance means what is the expectation in the next quarter. The most important thing. It does not matter how great earnings is, how great revenue is. If company says that the next quarter we may not be able to produce this return, stock drops. This has happened with Apple, Tesla, with a lot of these companies. So on the night when Netflix showed their earnings, all three factors very positive. Stock was at 850 because earnings come out after the market is closed. So you could not trade during that time. Next evening when markets opened, stock opened at 950. Gap. $100. This is the power of, so you don't trade stock for the first 2 months. But when the earnings are going to come out, you need to trade in the stock, because if the stock is good, like Netflix, for 4 quarters, each time the earning has come out, the stock has moved higher and fundamentally back because the earnings are coming positive. You can see earnings very easily. But here, what I'm showing it to you, and you can test it out. So look at this table. So what we did, we realized that earnings are playing a very important role. But obviously, you need to know that what happens post earnings, right? So we started coming up with a price action analysis, and we started looking at the stock which are going to come up with the earnings. What we have done, if this is a second quarter earnings, for example, we go 10 years back, second quarter, year on year for this stock, say Western Union, for example. So what I have done, what my research team has done is, I will see in last 10 years, second quarter, after earnings, how much Western Union stock has moved, irrespective whether earnings come good or bad. What I have seen is, if, so the earnings date 28 July, after hours, probability of an up move 43%. This probability is on the basis of last 10 years of earnings which have come out with the impact. If you buy the stock on the day of earnings, hold on to it until the night, an average movement of 4.1%, okay? And if you see the majority of maximum gain and maximum loss, so this is where it becomes really interesting. Now, this is for all those traders who, or investors who have difficulty in assessing the risk. I am telling you, Western Union, if you buy it on the day of earnings, hold on to it, the maximum gain you could make is 6.4%. Maximum loss could be 8.3%. This is on the basis of last 10 years of statistics. If you buy the stock and hold on to it for a week, maximum gain 8.04%, maximum loss 10%. If you hold it to a month, 12% maximum gain, 15% maximum loss. This gives you an idea whether I want to hold this stock for a day, for a week, for a month, and what is the probability of an up move after the earnings. This gives you a lot of numbers. Imagine, so what did I tell you? I told you about risk reward, right? Talking about one company. Do you know how many US companies show their earnings in the quarter? Every single one of them, most of them. And this includes, so I think tonight is the earning for Apple and other tech companies. Have a look at it and see how much the stock price moves. Today is the time that when, if you have to trade, if you have the idea that stock is going to go higher after the earnings or lower, you do that. But this analysis helps you in understanding an average probability of how much a stock could move higher. So imagine this is what is called strategy-based trading, okay? This is, again, as I said, apart from your long-term investments, your risk rewards, your fixed income, real estate, stocks, assuming you have done all of that. This is something which you can look into. This is, again, very event-based. You don't do anything for the first 2 months, but January, April, July, October. These, every single quarter, these earnings come out, and you will be surprised to see the amount of movement, which 8%, 10%. Look at this, for example. On the day of earnings, average movement 4%, 5%. If you see this one, look at 29th July, and if you're lucky, let's see if we have for 30th July as well. If you look at these stocks, Boeing, for example, Boeing stock, the earnings came yesterday. Look at the probability. It was 63% probability, and stock did move higher after the earnings. So my point is, if you pick out 10 companies and you look at the probability and trade in the same manner and spread your risk, the net impact could be again positive. There are some really good quarters, guys. There are some really bad quarters. Of course, during the pandemic, the earning was a disaster. But post-pandemic, we saw a lot of movement happening. Like this, each time, imagine a stock will come out. You just pick the one with the higher probability, right? And you could pick one of them or 5 or 6 of them just to diversify more from different industries and try to invest. So from Whirlpool to Cheesecake Factory, Freshworks, Mara Holdings, all of this, they have, look at their probability, 29.27. So you may not end up buying the stock, you might end up short selling the stock, which I personally don't really like to do, because when it comes to companies, we always expect it to go higher on the basis of the numbers, same the companies also. But you can pick out the ones which have a higher probability and trade in those. So price action analysis helps you do that. Okay. Now one last, yeah, please.
The issue between
So, ma'am, in this case, so she asked the question that how you find out the probability. The probability is on the basis of the last 10 years, same quarter, when the earnings have come out, whether they have, after the earnings have come out, whether the stock has gone up or down. This is a sort of data which is not available on Google. You go to NASDAQ earnings calendar, you look out the earnings for the same quarter last 10 years, and then you calculate the probability. And that is how, this is something which our research does. So we qualify in mostly strategy-based investments. Of course, normal portfolios are always available. Think someone asked here about the smaller market value companies, right? Like large caps are there. How we pick out the smaller market value companies. We created one portfolio, and this is something which is available on our website also. And there are a lot of such strategies which are there on our website, and you can always look at it. So this is just one thing which I want to discuss before we take questions. So this is a very important part, because we invest in large caps. Yes, the small caps get slightly discouraged, because we have seen over a period of time. See this. So here, so this was a portfolio which was called high beta, high alpha portfolio. Most of these companies are smaller market value companies, okay? I'll tell you the reason why we picked those. And again, this was a play on a very futuristic idea. Look at these companies. If you look at the market caps, 1 billion, 2.4 billion, 8 billion, 65 billion, 1 billion, 4 billion, 2 billion. Most of them are again lower market value. I would say small to medium. But if you see what these companies normally do, you're looking into biotech, tech hardware, storage, aerospace and defense, electric equipment, biotechnology. When we look at smaller market value companies, instead of the price action, please check what is the financials. Always pick small cap on the basis of financials. I have seen a lot of investors picking penny stocks just because that stock is at 60 cents or 50 cents. It used to be $10, it has come to 50 cents. You buy 10,000 shares because you expect that one day it is going to go back to 11 and you will make $1 million out of it. 95% of the time, the stock drops. You need to know that why a stock which was $11 has come down to 50, 60 cents. For example, one of the sectors which obviously we don't talk about, but in global markets, it is being invested into, which is marijuana. Now, marijuana industry, it is close to a multi-billion-dollar industry. If you see the stocks within marijuana, there are 3 kinds of stocks: the ones which are growing weed, the ones which are supplying weed, and the ones which are using weed to make drugs or research, for example. All those 3 sectors have different companies: Canopy Growth, Aurora Cannabis, Tilray, for example. These companies were doing really great in 2017 when Canada legalized the use of recreational marijuana. The stocks went up. But after that, due to excess of demand and not being able to meet the supply, the industry has been hit. All the stocks, a lot of them have come down. So stocks like Tilray, which used to be $20, $25, it went down to almost $1. Even after you buy that, the stock fell further. Sundial Growers, for example, went down to 40 cents, 50 cents. Sometimes you need to know that why the stock has fallen down. If you look at these companies, for example, look at the reason why we are buying this. So, for example, this one, Intella Therapeutics. So you see a lot of this. If you see their numbers right now, look at so market cap $1 billion, right? If you see price $11, target price 49. Why? Because these are very futuristic companies. What do? Clinical stage genome editing, DNA sequencing or gene editing or gene therapy. It is one of the most futuristic idea which has been going around. This is basically how to sequence the DNA of the body to find out that what kind of diseases the body could be vulnerable to, so that a timely diagnosis can be found. DNA sequencing years and years ago would take a lot of money, but now it just takes a couple of hours and a very smaller amount. There are companies which are getting into it. Imagine this: medicine by producing therapeutics that permanently edit and correct disease associated genes in the human body with a single treatment course. Also creates engineered cells that can treat oncological and immunological diseases. Now, when we are picking out these terms, we are trying to understand that what these companies are doing. Promising result in its clinical trials, better known as hereditary angioedema, a genetic disorder that causes unpredictable deliberating swelling episodes. A lot of these diseases which do not have the cure, there are companies which are doing drug trials. So if you, a lot of times when you see their balance sheets, you will see the compounded average growth negative. Why? Because all their trials, all their drugs are during the trials, but they are at stage 3 or clinical trials or on the verge of getting approved. That is why there is no growth in the revenue. But if those drugs get approved, then the $1 billion revenue stream opens. So when you invest in a small cap, you need to look into that part, that what the company is doing. There are so many companies. If you see, yes. So, ma'am, what we did, this is a top-down analysis. We look at the industry first. So if I'm looking at gene therapy, I try to pick out the top 5 companies in gene therapy and then do a proper fundamental analysis in terms of finances, in terms of what drugs they have, how many of them are into a trial, because this area has some great companies, some really bad companies, right? Just like EV, for example, electric vehicles, we all aware about electric vehicles. There was a time that electric vehicle means Tesla, Tesla means electric vehicles. But then if you see here in Dubai, Tesla is more of, it has come and gone. But BYD, Chinese companies have stepped in, and China still continues to be the largest exporter and manufacturer of EV, right? If you see, even in terms of battery efficiency, Tesla comes 4th. First is BYD. So we pick out the companies and then we start looking into what kind of trials they are doing, what is the stage, what the company is run by. It is purely fundamental. This is not technical, guys. If you're investing in small caps, price action, technical support resistance, candlestick doesn't help you. Because if you do wrong, this is high beta, high alpha, which means high risk, high reward. I will tell you, this was done in April. If there were 10 companies, 4 or 5 were in profit, 4 or 5, they went down. So when we are pitching this to the investors, we are telling them that, see, this is what the portfolio is made of. Not, the ideal thing will always be that I want all my stocks to make money, but there's a chance that some of them will fail, some of them will do good, but the ones which do good can actually bring your portfolio higher. See, like EV, robo taxis, for example, or flying taxis, something which has been a very popular concept. If you look at a company called Archer Aviation, for example, which is taking care of these projects which are happening in Dubai regarding robo taxis. You look at that stock, it's around $9 or $10 right now. There is a company which is into hybrid electric vehicles, but airways. So there are companies which are there, $1 or $2 companies, but they're still very futuristic, good companies. So we could do research and we could provide it, sir. I'm sorry?
Some 5 years,
10%.
the stock of this company will go down because I do understand the whole analysis that you're doing. And I do appreciate such, by the way. It's very, very good. But let's see, from us as developers, manufacturers, the devil is in the details. What people put out there, it's their ambition. For example, this technology that you have is based on CRISPR-Cas9.
Yes.
CRISPR-Cas9 has become legally investigated. One of the main issues is offshoots, it's cancer, and it's not controlled. Phase 3 trials has been done there, but it's not been licensed in the US. So when phase 3 will go there, they will face the same problems because it's a specific targeting of certain genes, which is a very highly sophisticated technical thing, which most people who are just investing will not understand. And when you look at it, it's like, okay, it's a nice story, but I'm just using this as an example because this I'm familiar with because this was developed in
Exactly. So
another company not have inside
yes,
with the promise of sending, rockets to the moon that
Yeah.
are based on hydrogen, but they never really developed the hydrogen engine that can withstand Mach 2 or Mach 3 speed,
yes.
which is a very technical challenge. As an investor, I look at the brief, I look at the probability. It's a bit like gambling.
What one thing which he really pointed out, so thank you so much, by the way. What he really pointed out is the very real possibility of the failure of this company, right? This is so, sir, you're exactly right. When you're looking at a smaller market value company, especially companies like this, as I said, if I have marked 10 of these companies in the portfolio, not all of them would make money. But that is why we put them into a very high risk category. So as an investor, so small caps are high risk, high reward companies. What he pointed out is exactly right. That if the technology doesn't work, or the worst thing, if tariff fears, we still do not take into account tariff fears in smaller market value companies. Maybe the company does well, but the moment right now, the worst industry which is facing tariffs is pharmaceuticals at the moment. So if tariffs go much deeper and pharmaceutical takes the impact of it, maybe this stock doesn't work. But if there are 10 of these companies, so same like space exploration, for example, right? Space exploration is one idea which we always see. Elon Musk is very excited about it. SpaceX is one of those companies which probably would come up with the IPO, and it has already been in the pre-IPO and talking about. Now, space exploration, some of you may not like it at all. There are some enthusiasts which like it. But the point is, if this happens in the future, right? If you lose that opportunity. So my point over here is, again, never to invest your full or majority of the amount in these things. The reason why I call it high risk, that maybe because this is more futuristic in a bunch of companies together. So this is the portfolio of 10 companies which has a mix of biotech, which has a mix of crypto mining, for example. Crypto mining is one such thing, right? If crypto doesn't become something, the crypto mining companies will not be worth anything. But if you are putting 4 or 5% of your invested amount in this, right, that is what you need to calculate it. So I started with the idea that, see, this is a high risk, high reward strategy. There's an idea that a lot of these companies may work. There's an idea, a majority from April to July, the portfolio was in profit, could check the prices. But then again, the long-term viability, some companies might fit, some companies may not. So what we do is we try to pick the best out of the industry. Industry itself, anything which is futuristic, it will take time to get accepted. So if you know, EV was not we did not accept the EV the moment it started. Tesla, for the first 15 years, Tesla did not have any profit. That is what Elon Musk's entire pitch was, that I don't have Tesla for profit, right? But still the stock continued to go higher. That is the problem. So there is one part which we have to consider here. Sometimes, let's say, the information which you shared, it's very good and it's very informative and it's very reliable also. But sometimes what is happening, companies like in this kind of industry, we have seen investors taking interest when institutions take interest. Now, the market, unfortunately, is run by institutional investors also. Same thing with cryptocurrencies. If you remember, there has been a very strong argument against whether crypto will actually become money or no. Will central bank actually bring, because I know that there is a team of researchers in MIT who are working on digitalizing a dollar. If dollar gets digitalized, do we need cryptocurrencies? Why Bitcoin is $120,000 right now? Institutional investors. So at this point of time, as I say, we have to invest in different companies. We have to invest in different futuristic sectors, smartphones, electric vehicles, space exploration, DNA sequencing, blockchain, fintech. These kind of industries will have different kinds of companies. Some of them will be strong to bear the brunt. Some of them will be weak and fade out. So we try to give the ones which are more stronger. You are never advised to put a large sum of money. That's why we call it high risk, high reward. You put at least 2 or 3% of your total investable amount, and that is also after once you have diversified everything. Right? So
Sometimes the relatives make the stocks go high, just like your
all the time. Yeah.
We are making a deal that company will do that. So based on the speaker, the shares prices are going on.
But absolutely. See, that's why my second or third slide was about how do we know that the momentum is mostly madness. That is why when we are picking out a small cap stock, we have to look financials. We have to look, see, this is the information which is accessible to us, right? So if I'm reading here that they have focus on these kind of things, I would do the same thing for about every company. So what is your basis of picking a stock, whether here or in India or any other country? Your basis of picking a stock is you look at their balance sheets, you look at their numbers, you look at their future plans, right? Sir, exactly. Numbers can be fabricated, but then, sir, but the point is there has to be some anchor to which you would take your investment, right? The only way to find out whether the numbers are pure and pure is either you are the part of that company or you're working in the company. There's no other way to find it out. Today, if Tesla, for example, if Tesla says that we have done this much amount of deliveries in China for this much, only thing the investors can do is look at the news and buy the stock. Nobody's going to go to China and check how much Tesla has delivered. Only Elon Musk would know, or the people in the Tesla would know that how much. This is the very big risk, which is a market risk, by the way, which we face. Market risk can only be diversified, it cannot be removed. Because if we start questioning that, then we start questioning everything. Because then we even start questioning whether this Nvidia rally is solid or not, whether Microsoft is a good stock or not, the numbers which Amazon is showing is true or not. There's no other way to find out, right? So that is a loop which we get always stuck in. But that market risk, which you pointed out, sir pointed out, market risk can always be, so we always say that is why this market risk needs to be diversified, even in terms of sectors. Would you put everything into biotechnology? Would you put everything into EV? No. So what do? You put into IT, food and beverages, real estate industry, chemical, mining, aviation, hotel industry, healthcare, medical equipment, even in, so there is pharmaceutical, there is hospital, there is medical insurance. There are different kinds of companies within the healthcare sector also. Some of them are tech, biotech, some of them healthcare companies, which gives you dividend also. We tell you to diversify. That is the only way market risk can be reduced. This kind of risk will always be there. But see, again, if we don't invest here, if we don't invest in stocks or businesses, what are we investing in? Real estate? Investing in fixed income bonds? We are putting our money in the bank. Any investment else which you do in terms of private equity or venture capital, this is same as what we are doing, slightly more riskier than that. So we take that chance, but that chance needs to be calculated. That is what the idea of this session was, that you have to diversify. You have to pick out something which is apart from the convention. Of course, you're never forced to do it, but it is prioritized that you must, because see, I'm talking about the people who are 30 to 40 years old. You know that you're stuck in the wrong generation right now. Generation before you kept telling you what to do. The generation after you is not listening to you, telling you what to do. Correct? You're stuck here. So your prior investment decisions were taken by the generation before you. Your current investment decisions are taken by the generation after you. You have to follow. This is something which is a realization, because today you can say no to cryptos, but the Gen Zs, what are they doing all day? Now you can choose to be away from that noise, but the real fact is, if you stop that, before November when the elections happened, Bitcoin was 30,000. Now it is 120,000. Missed out on the rally. That's the fact. Whether good or bad or it's not, but at the same time, every single crypto in April first week, Ethereum fell down to $1,700. It is July. It is $3,600 right now. 100% return in 3-4 months. It has happened. I'm not saying that you should have put all your money, but 1%, $500, $600, put in it. So that is how we have to understand diversification is needed. Of course, there are different ways of doing this. There are different ideas where we can look into. But most importantly, we have to find out which are these companies, whether it is stocks, whether it is commodities. If these are commodities, ETFs for long-term investors, ratio and pair trades for short-term investors or medium-term investors. If these are indices, for example, so one thing which we wanted to touch base on, SIPs, systematic investment plans. SIPs is based on compounding, which is Albert Einstein called it the eighth wonder of the world, where your returns earn returns and you don't have to take your money out. So it was a very, very good story, right? There was a king who was very impressed by a wise man, and he told him that, okay, ask whatever you want, gold, palaces, land, anything. And the wise man said that I don't want anything. Open a chessboard, and each square just put 1 grain of rice and keep doing it double. And the king thought that, oh, it was nothing, let's do it. Did not realize by square 64, the amount of rice was 18 quintillion, which was not even there for the whole kingdom, because each time the rice got doubled, by the square 40, it reached to trillions of grains. This is what compounding does to your investment. SIPs do the same thing. S&P 500, 10 to 11% on an average, the index moves. What you do today, you dedicate any amount, even $100. Every 15th of the month, $100, I'm going to buy, say, Vanguard S&P 500 ETF. Vanguard is a very strong company. It's in US. They have created a S&P 500 fund. Don't have to buy the index. Just buy the fund. No leverage cost or anything. Just buy and hold. Never take that money out until you really feel that you have earned money. This is for your daughter's education. This is for your long term. If you need to open a restaurant after you're retired, keep funding your SIPs. And the time when market falls by 5 to 10%, buy more, put more money into it, because the higher are the chances that eventually that discount will get filled again. So SIPs is where your return earns return. So today you put $100, you earn 10% over it. Now your next 10% comes on 110, and it keeps multiplying. It is slow and steady at first, but you will see the magic happening after 9 years. Every 9 years, you will see a drastic change happening in your investment. So SIPs are your long-term ideas. Never ditch your SIPs. This is, I mean, majority of our clients are the ones who do trading. But this session is not about just talking about trading. This was about an overall understanding of the investment. So we have covered diversification. We have covered pair trading strategies, seasonality analysis, portfolios, small caps, risk reward ratio, putting your stop losses. And I think the one very important thing which we have to understand also in terms of takeaway here, that momentum isn't always wrong, but needs context. So you need to have data, just not emotions. Like sir rightly said, that if you have knowledge about something, you have to find it and you have to see whether this is a profitable investment for me, not just emotions. Emotions, markets are run on emotions, but you as an investor, you have to manage those emotions well. Invest smartly, not quickly. Please do not get FOMO. Markets always give you an opportunity. Just stay invested. Okay. Always know why you are investing. This is the most important part. The why is really important. He questioned that, why do you want me to invest in it? What is the reason behind it? Why should I invest into this industry? Never blindly follow what your consultant tells you. I know it becomes a little boring at times to know about these things, but this world at this point, knowledge is everything. Today, if you know more about something, you have gold at this point. Like there are so many websites which you feel that they're providing the service for free. But even those websites take something very important. data, your spending habits, your purchasing power, every single thing this is gold. Information is gold at this point of time. So always know that why you're investing. And again, we do a lot of seminars, we do a lot of webinars also. This is something which we have always felt that awareness is always needed. Uh, I've worked as a trader for the longest period of time, and I know that the markets become so volatile. It's not easy to be a fellow investor out there. So there you're going to make money, you're going to lose money. The best way to find a balance is please diversify this. Always diversify. Do not go at the tip of the pyramid directly. Need to have the base first. You need to have your fixed income investments within stocks, some dividend companies, some good tech like Amazon and Apple's, and then some riskier futuristic companies into renewables. You're talking about solar energy, wind energy, you're talking about DNA sequencing, fintech, blockchain, all of those companies, because that is what the future is. There are companies which are making technology to improve the fertility of the agricultural land. Now, if you see that the agricultural land has been losing its fertility for the longest period of time. If there is, so this is an area which is called ag tech or agricultural technology, which has been an emerging area for a while now. But like this, there will be more and more futuristic things. Like smartphones were not something which we thought of. BlackBerry was at its prime, right? We always thought that the best business phone is BlackBerry. Where is BlackBerry now? That is where we have to capitalize on it, because eventually we have to evolve even in our investing patterns as well, right? Anyone who later on, sir, please. I'm sorry, sir. The high frequency trading through a certain jurisdiction we can try. We are the market makers, so we can try to do that depending upon the volumes. We'll be able to find it out. So this is something which we are still exploring, because we have had some requests for high frequency trading. If you're able to bring that kind of liquidity sometime, we can try to provide it to you. But I think a discussion can be done. Yeah.
Reference to trade, a lot of the data is analytic.
Yes.
Based on previous expectation probabilities, projections. If this data is available, is it not fed to an AI? Do you have an AI with this probabilities that can be interactive? Let's say, today I wanna play this year, exactly and play. And I don't have all the data from that month, and then I can ask the AI for any advice on today, what is seasonal, what is the highest probability, because all this data is, I don't know.
Yeah.
And it's very difficult to go through. If it's digitalized or put into a.
So, sir, in the platform, just for the, so his question was very important. That is, when if we have to invest or if we have to trade, for example, is there some sort of algorithmic or AI related understanding of where the market is trending towards? So there are two parts. One is normally from our end, what we are trying to do is provide a consultant to every client who is mostly real time looking into the markets. From a technology perspective, the platform is equipped with tools where the charts on technical basis are updated every 30-40 minutes with the possible trend showing higher or lower with entry and exit points. This is something which is irrespective. This is in your platform within technical views and technical insights, and you can take advantage of that. Because this is something which is for a short-term trader, it's a really good idea because he's able to get access to every 30 minutes chart with entry and exit points. So that is available. There is no copy trading or algorithm trading which we provide, because we have consultants, so they're doing live research and we are talking to the clients. That's the idea. Yeah, yes. So we are still trying to do that, because I think somewhere the strategies like pair trades or price action could not be created through a copy trade. So a lot of our guys actually put their minds into it and found out 30-40 pairs, including agricultural commodities and indices. Like for 5 years, we traded in one index pair, which is called NASDAQ in South Africa. We also call it NASA. What we did was we realized that over a period of 20-22 years, NASDAQ has outperformed South African index majority of the times. And if you buy NASDAQ, short sell South Africa for the year, most likely the hit ratio of the strategy was around 80 to 85%. So a lot of people did day trades in it, long-term investment in it, trying to find something different and something new. That is the idea, but this is apart from the conventional investments. We are providing expertise for all of it. So it's basically a one-stop shop. I think the Fed announcement is going to be happening soon. If the central bank continues to keep the interest rates higher, that still makes the later on the bond investment slightly more lucrative after this, because whenever the Fed decides to cut interest rates, the fixed coupon bond prices might go up. So right now, because of higher inflation, bond is not something which a lot of people would want to go for. But once a rate cut cycle begins, you could enter and buy fixed coupon bonds from the platforms, and you can hold on to it. So from bonds to commodities to ETFs to long term to short term to strategy based, every single thing is provided to you. Even after this, if anyone requires a one-on-one session later on, we can definitely have it personally or over Microsoft Teams or Zoom. Until then, if you have any questions, otherwise, thank you so much. You guys have been very patient, and if I say no now, then people will tell me. Yes. Yes. Yes.
All this is digitalized.
Yes.
Easily automated.
Yes. Yes.
So
it's a very popular concept, but see, I still like to believe that algorithmic trading has been there for a while. Algorithms, of course, without a doubt. See, but so the point is, we still like to. So at this point of time, we are using AI to complement the research, not trying to replace it. That being said, I am never the kind of person who feels strongly that this is going to happen, because I've seen things changing. So it will be very ignorant of me to say, no, it cannot happen. Of course, it can happen. But I also like to see that somewhere the way markets are these days, markets is still run by people. So the abnormally which the algorithm tries to perfect it, that is the unfortunate part, that it cannot be perfected. Today, last 3 days, markets have been ruling higher. And when everybody tried to step in, we have seen a fall today. Gold prices, which has gone 3,500 2 weeks ago, is now 33. This is not, even if you put technical indicators to it, you will see a sharp change in the technical indicator. Something which was suggesting a buy is now suggesting a sell with a spur of a button. This is a lot of human emotions. So I still feel that we would want to work in an environment where it is complementing the research, trying to make it more better. But yes, I mean, I'm very open to the idea that AI might very well take over and try to come up with something which is brilliant and big. But that is going to be a very efficient form of market. And that's the problem. I don't think that the. Yeah. So I would definitely invest in semiconductors, by the way. Semiconductors is the new gold. Trust me, semiconductors, whether it is TSMC, or there are very few companies which are supplying semiconductors. So semiconductors is the new gold. Whether it is driverless technology or autonomous driving or any kind of technology, IoT, Internet of Things, fintech, semiconductors are required everywhere. So chips and semiconductors, this is the new gold. If obviously it's one of the most currently the sector is it's very hot right now. But companies like Taiwan Semiconductor Manufacturing Company and ASML, these kind of companies, if you feel that are available, you could always have a long-term exposure in it. Right. Thank you so much. Yes, question.
Fed will come up with a meeting. So
Yes.
what is the immediate?
Ma'am, most likely, I think it's 9. So I think another 1.5 hours. If the interest rate decisions, most likely they're expected to keep it same. We're expecting dollar to become more stronger because Japanese exports have dropped a lot. Against dollar yen, we have seen dollar yen is rallying, but dollar index has also started growing higher. Somewhere investors have started finding a safe haven in USD. So I think dollar is definitely, we are looking at a stronger perspective. With trade tariffs coming in, inflation expectations are expected to go higher. So I don't think Fed is going to cut rates anytime soon. Trump has been pressurizing a lot to Fed, but I just still feel that it's a stronger market for the dollar. Gold, excellent buying at 30 to 60 levels. So it is a range between 30 to 60 to 34.50. So as of now, gold is pretty much on a very good support. as dollar gets stronger, we like to see that gold falling down, but that relationship doesn't work every day. So right now, gold is basically on the support level where central bank buying and other uncertainties, tariff uncertainties, for example, or any geopolitical tensions, Russia-Ukraine tensions are popping up again. So all of that can push gold still on the higher side. Euro, I have seen falling down a lot in the last 3 days. Although the German equities or European equities, I still see bullish because Europe is going to spend more money on the defense budget for the next 5 or 10 years. So from a EU defense idea, I think that is one bullish area to invest into. China, for always, been saying since 2023, Chinese equities, if you need to be bold and brave, but at least have some exposure in Asia. Japanese equities and Chinese equities, both Chinese equities fell down a lot, but eventually it recovered. So you have to have a multiple exposure. That being said, Gulf markets are not doing too bad. In fact, year before that, Gulf markets were the one which outperformed. So even if you have investments in DFM or UAE markets, there are a lot of companies which are going to come up with the IPO, and there are a lot of companies which are giving you good dividends. Salik, for example, or Diva, these are like government bonds at the moment. It's less, but again, as I said, that a bit of exposure into everything. So that's because in 2022 and 2023, when most of the global markets underperformed, the Gulf markets outperformed. So that was a very good point. Anybody who would have invested in it. So a bit of it into everything. I mean, never completely be focused on. I would never tell you that put all your money into one industry. There is an asset class diversification. There is a geographical diversification. You need to have the best of all the worlds. Invest in Indian equities also, invest in US also. Do it through ETFs, do it through funds, but do it into indices. Like, especially when the industry is like what he rightly suggested, that something which is riskier, like DNA sequencing or space exploration, don't pick one company to do that. Invest in a fund. So if one company goes bust, the entire fund does not suffer because of that.
Can we have this presentation?
Yeah, definitely. This can be sent. And every strategy which we have discussed will be sent it to you. If you have forms, just fill your name and numbers with your email addresses so we can do it. If you have already done it before, not a problem. Your parking can be validated for 2 hours. So before you do that, please do that. And we have some food and refreshments for you. Once again, thank you so much for coming. Evening time, I know that.
Wonderful.
Thank you so much. Thank you. Please let us know if we can be of any help, and we can have more sessions later on, and we can definitely.